If we are responsible for our own retirement, should I not have access to where capital formation is happening? Should I not have access to where the home of yield is, which is not the banks anymore?
Welcome to a new episode of The Blunt Dollar. Today we have the great pleasure of having with us William Kelly, kind of a superstar in finance because he's the former CEO of the CAIA Association, a seasoned asset management executive with over 40 years in the industry.
Most investors want zero downside risk and capture all the upside. That happens in a place called fantasy land. We're giving the investor what they want versus what they need. What do they want? More liquidity, when the underlying is illiquid. But if you're 65 and you haven't saved enough and you're trying to Hail Mary pass into the end zone and make up for the lack of commitment to capital to your retirement that goes back many, many decades, good luck with that. I firmly believe that asset management will never, ever be a profession.
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Hello everyone and welcome to a new episode of The Blunt Dollar. Today we have the great pleasure of having with us William Kelly, also known as Bill, a seasoned asset management executive with over 40 years in the industry. Bill is kind of a superstar in finance because he's the former CEO of the CAIA Association, where he championed education and transparency in alternative investments, helping grow CAIA into a global standard for alts proficiency. Before that, he co-founded Boston Partners Asset Management, steering it from a boutique startup to one of the largest independent money managers of its time. Bill's career stretches from his early days as a CPA at PwC to leading roles as CFO, COO, and even CEO across major asset management firms, including Robeco Investment Management. And beyond the boardroom, he's been an outspoken advocate for investor protection, governance, and bringing more rigor to private markets investing. In this conversation, we'll dig into the evolution of alternatives investments, the democratization of private markets, the promises of and perils of data-driven investing, and why education and fiduciary duty matter now more than ever. Bill, I'm incredibly excited to have you on The Blunt Dollar. Welcome to the show.
Thanks, Ignacio. A pleasure to be here and of everything you just said, and I appreciate the kind intro. Longevity is a fact, so hopefully after 40 plus years in this industry, maybe that gets me something, but I take nothing for granted.
I'll tell you what, we don't have the honor to have people that have worked 4 decades in finance every day here in the show, so I'm really, really excited about this one. I like to start the show always asking the same question. Tell us a little bit in your own words, what is it that you're doing today exactly?
So it's been an interesting journey. I retired, if I could use that word, from CAIA, which was my full-time, all-time gig, very best job I've ever had. I was in that position as CEO for 11 years, but did retire at the end of 2024. So it's been 6 months of a discovery and trying to figure out this next phase. I've embraced it because I think there's a great amount of opportunity, and I'm probably in my last leg of however my career is defined. I turned 65 in January, which means a certain level of seniority in the U.S. I get a discount at movies and on the T into Boston. But beyond that, I'm hoping this next phase, I could take a lot of what I've learned, a lot of great contacts, a lot of great people I've met, and really try to continue to weaponize that for the end investor. So more specifically, I came into this role as an independent director. I've been on the Artisan Partners Mutual Fund Board. It's a manager here in the U.S. with about 150 billion of assets under management. So I'm going to continue in that role. I'm also and have been the lead independent director on Boston Partners Trust Company for well over a decade. I'm coming on as a senior advisor to Star Mountain Capital, a lower middle market private capital shop. And then I've just
Mhm.
recently joined the board of Macquarie that's got an energy transition infrastructure fund. So a lot of interesting outlets, but maybe to pull it all together, my podcast for now continues. I have my own newsletter on LinkedIn with almost 8,000 followers. So my ability to interact and hopefully even on the margin influence better outcomes for the end investor is still very much alive and well, and how I plan on spending this next phase of my career.
Well, congratulations. You're definitely a model and inspiration for the rest of us. And yeah, I hope I make it for as many years as you in this industry. I'll tell you that. But yeah, by the way, if you're not following Bill on socials, if you haven't listened to his podcast, please do, because it's full of incredibly interesting insights about how the industry operates and about the people working in it. And I could only recommend it to all of you. Um, so let's take a step back. I want to ask you. I mean, you've done so many different jobs. You've led like a scrappy employee on startup, and then you've guided a global body like the CAIA, which are completely different animals. Uh, and I wanted to know, what did you find most challenging about shifting between these more entrepreneurial parts of your journey with leading and then stewarding established institutions such as CAIA?
Well, I think a lot of us have plans, and I think planning is an important part of strategy, both in business and in life. So I'm not dismissing where that fits in, but then the real life, real economy, real sets of situations get in the way, and they come with both risk and opportunity. And I think a lot like an investor, you can afford to take more risk in the early stages of your career because maybe
Hmm.
you don't have any kids, you don't have a mortgage to pay, you don't have to worry about retirement for decades. So I think you should find ways of embracing risk, embracing disruption, and running toward those problems and opportunities when you're younger. And maybe germane to your point, Boston Partners was an employee-founded startup wrapped in litigation and a lot of risk, both personally and career-wise. And we started that circa 1995 when I was 35 years old, and I had three young kids at the time. My ability to do that, say when I was in my mid 40s, where the tuition bills were ringing up and the potential of walking away from a lucrative career maybe had more downside risk attached to it. So
Hmm.
I think you've got to look at your career in segments, but I would say most importantly, and this has benefited me hugely, what I just alluded to before, which is running toward the problem, embracing things that you have no business embracing in the first place. And I think a lot of young people have the potential of having certain aspects of a corporate plan delegated to them. And somebody might easily say, well, you know what, I can't take that on. I'm not capable of doing it. Take it on and figure it out. And failure is always an option. And the old saying, fail
Hmm.
forward and fast, is very much in play. But embracing that is going to teach you lessons that might take normally years to decades to learn. So I was a student of discovery, a student of taking on things I had no business taking on in the first place, and failing certainly early on in my career, but it did benefit me. And if I look at my career in Sachem, as I alluded to, the transition from a big corporate enterprise, the Boston company owned by Shearson, Lehman, American Express, and then Mellon Bank before BNY was on the scene. So anything you needed as an employee was available: facilities, HR, et cetera. Stop Boston Partners as an entrepreneur. We did not have a paperclip to our name, no facilities department, no HR, no finance function. So you really had to figure out a lot of things that you relied on and figure it out yourself and get it done. And it had to be done quickly. You had to make those mistakes and pick up the pieces and move back on again. And we grew that today through the success of people that followed in my footsteps. It's now over $100 billion asset management firm, and great credit to the folks running it today. It's awesome to see what it's become. And
Hmm.
I moved on from there in the just after the GFC, early 2009. Started doing some independent board work, but I think by temperament, and maybe your listeners can sense that, I wasn't really wired just to be sitting in a boardroom at that tender age. So Kaya came knocking, and I saw a tremendous opportunity that really played into my wheelhouse, which was investor education, trying to get access, but via informed consent. And I would say, pound for pound, the 11 years I spent at Kaya was the very best job that I ever held. So maybe I'll take a pause there to say there is no grand plan. And it's not as if
Mhm.
I sat here in my early 30s, Ignacio, to say, well, by the time I'm 50 or 55, I don't want to be running the CAIA Association. CAIA Association didn't even exist back when I was in my 30s. So it is a period of discovery and opportunity, and I think you can direct it, but I think curiosity is highly correlated to luck, and we all need some luck in our careers too.
Mhm. So we're gonna be talking about Kaya, of course, but I have a confession to make. So I'm a CFA charter holder, and one of the things in my to-do list that I have to do before I die is getting my Kaya. Especially because when you get your CFA charter holder, you automatically qualify to have like level one of Kaya. So I would just need to do level two at this point. Um, and I haven't done it. I'll confess, but it's on my to-do list. I'll have to do it at some point. But yeah, I want to ask you about your period there, especially when you were the CEO. How is it to be the CEO of such an important organization, such as CAIA? It's like kind of a superstar status out there that everyone respects tremendously. Being like yeah, asset managers, wealth managers, you name it. How were your years there? What is it that you like the most? Share a bit of your experiences and your journey. I think it would be really cool to have the juicy little insights and maybe a few cool stories.
Yeah, so as I said, it was a great decade plus that I spent there, and maybe if I could put it into two broad corridors, but there's certainly a lot of other pieces that come into play. But I would say the first 5 years was all about raising the specter and the brand and what it stood for. And even today, ultimately, Kaya is a B2C proposition, very similar to the CFA, where the individual knocks on our door, registers for an exam, takes the exam, and becomes a card-carrying member. But if I compare the CFA as an example, the CFP to Kaya, the brand recognition for some of these global brands is much bigger than what Kaya was and still is today. And that's both a challenge and an opportunity. But if you're going to have individuals come and take your exam in this B2C play, they have to understand the resonance and what it means. And when they're done, what does it mean for them personally, their career, and hopefully, most importantly, for their client? And I saw a great story and a great opportunity to tell that story. So I would say I spent the first 5 years in my tenure at Kaya going out and preaching to the world what we were all about. Did that bring more candidates to our exam window in the short term? Maybe, maybe not, but that was not my goal. It was to eventually try to sell into an exam cycle that might have been 5+ years further out. The second half of my tenure was marked by the movement toward democratization, and now we're seeing this accelerate more and more, where the GP or the asset manager realizes that the future of their business model is the individual. If you see some of these studies, and I think Bain put one out recently that looked at the total AUM pie globally around wealth, and just over 50% of that pie is now held by the individual. So they're wearing the crown to the detriment of the institutional investor. And you think about it, it should make sense because I came on the scene as a working individual in the early 1980s when the defined benefit plan, an employer promising me if I stay with them for a certain period of time, they'll give me a defined contractual benefit for the rest of my life post-retirement. The world moved more toward DC or self-funded retirement, where the employer would put a matching contribution in place, but it would be up to me to decide how much I'm going to defer and how am I going to invest it. So as that DB to DC landscape shifted, and I think this is certainly true in the US and to a large degree around the world in varying capacities, the individual now has more control over the asset. So now the big GPs, particularly in the private capital space, are saying Come to my window. I have private equity. I have private debt. I have infrastructure. I have commodities. I have CTAs, which is all about the CAIA curriculum. And I think this is two sides of the same coin. One side is, if we are responsible for our own retirement, should I not have access to where capital formation is happening in the private equity space? Should I not have access to where the home of yield is, which is not the banks anymore? It really is in the private debt space. Short answer is yes, but then how do I accomplish that? How do I do that with greater literacy, greater informed consent for the end investor? These are very, very challenging issues to solve for. And if they can't be solved for, we have no business allowing the individual investor into a very complex set of risk premia, absent a guide to do it on their behalf. So that second half of my tenure was to both talk about the opportunity on the one hand, but be very, very clear about the risks on the other hand. And the industry has lobbyists to protect the interests of the GP. There is no lobbyist to protect the industry of the end client. And we've got to be very, very balanced and
Hmm.
open about that. And maybe a last point on this is that in the course of my entire career, and particularly the last decade at CAIA, I've talked to a lot of very, very smart people working for regulators, asset managers, asset owners. CAIA had over 60 academic partners. We had over 24 associations. I'm yet to meet an individual that would say, I don't believe in greater financial literacy. I don't believe in investor education. But who amongst us is stepping up to put sustainable dollars behind that to solve for it? I won't say nobody, but clearly not enough. And if somebody says, well, that's on the back of CAIA, a small but global non-for-profit, that's not going to get the job done. So we need to create a greater village. CAIA can certainly be part of that.
Hmm.
CFA can certainly be part of that. But we've got to solve for greater investor access to product through informed consent and greater financial literacy.
So where is the opportunity here? Should we go and pitch the regulators about this?
Well, we pitched the regulators around the world, and CAIA continues to do that. We pitched the asset managers, certainly the individual asset owners about some of the risks and opportunities there as well. But if you think about the average investor, the headline and the risk in front of them is very, very scary. And we saw this to a large degree in 2022, where for a rare moment in time, the 60/40 failed to provide diversification. The equity markets
Hmm.
drew down a lot, and when interest rates went from zero up by 350 basis points in a matter of months, it obviously had an impact on the bond side of your portfolio as well. So the 60/40 might have drew down something close to 20%. And those lessons sting, and they last for a long time. The euphoria of an up market investors love, but when they have that kind of drawdown risk, they are really licking their wounds. And what does the industry do? They go running to them and say, well, here's private equity, here's private debt, come into the deep end of the pool. And I think it's almost being sold as this is the return enhancer of your portfolio. This is the alpha engine of your portfolio, which I think is nonsense, because even a 5% allocation to private equity with maybe a 500 basis point delta between public equity risk premium private is not going to move the needle in a substantial way versus what the needle could move if we talk to the investor about just long-termism, making a cogent asset allocation decision and staying in the market for the long term. And just staying on this 60/40 theme for a moment, even despite what happened in 2022, at the end of 2024, for a rolling 10 years, the 60/40 finished just shy of compounding at 7% annually, which is really what the historical norms have been for 40 years. So despite what happens in one year, which investors have a long memory of that, long-term investing and the 60/40 has proven to be a very, very tough benchmark to beat. And if I said
Hmm.
to most investors out there that I can guarantee you, and that's a word we should never be using in
Never.
the craft of asset
Yeah.
management, but I can guarantee you a 7% return of these two asset classes, who wouldn't sign up for that? I think just about everybody would. But if we start drifting toward higher fee, more opaque product that has high illiquidity quotients attached to it and illiquidity risk, I think it's going to be very, very hard for the investors to see their way through that. And then ultimately, what we're now seeing in this phase of democratization is we're giving the investor what they want versus what they need. What do they want? More liquidity. Okay, I'll give you liquidity every single quarter with some caveats attached to it when the underlying is illiquid. And again, this is a perfect example of why investor education makes sense. We need to sit down with that investor, look at the liability side of their balance sheet, not the asset side, the liability side, and say, what are the calls in your capital in the next 20 years? And if it's tuition for a 2-month-old or retirement and you're 35, you can afford to bring on more illiquidity risk. But if you're 65 and you haven't saved enough and you're trying to toss, use a U.S. sports analogy, that Hail Mary pass into the end zone and make up for the lack of commitment to capital to your retirement that goes back many, many decades, that is a very, very difficult, if not impossible game to win. And I think we need to, in that latter situation, is smother that individual with transparency and honesty to say, there's no way you're going to be able to live the retirement you planned on. And you've got to think about maybe modifying some of your expectations. And maybe you can afford to take slightly more risk, but to put your entire retirement future into this game and think that it's going to end well, good luck with that.
Wow, long answer, but tons of truth in that. And yeah, the word guarantee for sure is something that we are not, we shouldn't even be able to think about when it comes to asset management, as you were saying. But going back to your role as the CEO of CAIA, so just for us to understand, what was your KPI? Was it like the number of subscribers, of people that were taking the exam, or was it something a little bit more like soft metrics were a little bit less quantifiable? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Yeah, it sounds like a little bit of a cop-out, but I would say the metrics are more soft than hard. And I've said this to candidates and members back in the day when I was there. If somebody said to me, well, we're sitting here in 2022, the beginning of the pipe for CAIA it's a 2-level exam. So maybe the most pertinent question would be, well, in 2023, what 1 year from now, what's your expectation of the number of level 1 new candidates coming to your window? And if I said, I expect it to be up 50%, 75%, rather than jumping for joy, the person that asked me that question should first off say, that sounds delusional, and then explain to me how you are going to get there. And when you've got a business with a small number of candidates, which CAIA does then and still does today on an absolute, and if CFA or CFP is the benchmark, on a real basis, very low as well, it can be very volatile. And I've got to first settle down not only that volatility, but settle down the long-term nature of where these numbers are going by precisely what I said before, getting on an airplane with my passport and going around the world talking to any regulator that's willing to have me in their foyer, any large asset manager, asset owner, talking to our academic partners. And some of the very best times I've had in my time at CAIA was talking to students. This is the future of this industry. And I could be talking to a student body of 65, 70 students. And this I was able to do many, many times around the world, from the Middle East to China to India to the US. And if I could just get their mind thinking about some of the risks and opportunities, it is an awesome outcome, because hopefully they take some of that away. And what CAIA stands for is ingrained on their mind. But an important caveat there too, Ignacio, which some people might be surprised by this. If somebody handed me a deck before I walked in, and that deck consisted of an overview of the CAIA exam, how many multiple choice questions there are, what topics we cover, what are the pass rates, how much does the exam cost? First off, you can find all of that on our website. And I would say if somebody handed me out a deck, I would give it back to them and say, you know what, I'll do this on my own. And my presentation has nothing to do with the exam directly. It is the subliminal popcorn on the screen, but I'm trying to sell the concept that this is not a straight line. Building wealth is very, very difficult. If you're down 10 and the market is down 50, that is a very, very good outcome. But most investors want zero downside risk and capture all the upside. That happens in a place called fantasy land. So I want to have these students thinking about, wow, I learned something new. I learned something new about the markets. I can use this information if I go in an interview tomorrow. And my big takeaway is it matters. And it being professionalism. I've got to act and think and behave like a professional. And whether they just do that with or without the CAIA, it's a victory on my part. So CAIA is not in the business, at least in my mind, of selling exams. It pays the lights, it pays the salaries of the people there. But our purpose is so much more higher than that. And it really is about improving professionalism in a very, very complex industry. And we can come back to this if you want. I firmly believe that asset management will never, ever be a profession. It is a great industry. It could be a great career. You could be more professional if you're in it, but the ship has sailed about us being a profession, and we can't just sit on our hands and say that doesn't matter. It matters body by body. And the more people with or without the credential we can get thinking in that mindset, it's a victory for the end client.
So can you elaborate on that? I don't think I follow when you say asset management is not a profession. What do you mean exactly?
Yeah, so a bit of a softball question to me, and you'll understand why when I give you my answer. So the student deck that I use, and I vary it thematically because things in the market and news cycle change. One consistent slide at the very end is the bust of Hippocrates, the father of medicine. And medicine has its flaws, but it is a profession. It was started by Hippocrates, who said, if you're going to be a physician, and every graduating student of a U.S. medical school, I don't know if this is true around the world, has to raise their right hand and a vow to the Hippocratic Oath. And
Yeah, I
amongst that
believe it's a
Hippocratic
global
Oath,
thing.
yeah, and amongst the Hippocratic Oath is that you're not going to suffer therapeutic nihilism, which is a fancy way of saying overtreating the patient. If the patient presents with a heart issue, but they're a cancer patient in their 90s, you're not going to do bypass surgery. You could have a lucrative insurance reimbursement if you did it, but it's not good for the end patient. We, as an industry, started maybe in the Netherlands in the 1700s. The first mutual fund in the U.S. just celebrated its 100th birthday last year as Mass Financial, just outside of my home
Oh, wow.
in Newton,
I
Massachusetts.
didn't know that.
And the CFA as a credentialing body didn't start till the 1960s. The CFP, maybe the 1970s. CAIA, the 2000s. So we're trying to retroactively professionalize a global business that's subject to regulation in 190 plus different countries. The definition of fiduciary here versus mainland China versus India has some commonalities, but some differences as well. What constitutes insider trading? What are the standards that we should act and behave under? If you're a CFA or a CFP, it's codified there, but it's not codified for the industry. And ultimately, pick your asset manager. They could go and hire whoever they want to run those portfolios. They may have to pass a FINRA exam, which should be a layup, but they don't have to have a college degree. They don't have to be a CAIA. They don't have to be a CFA. And imagine having an open heart surgery, and just before that the gas hits you and going to be put under, the cardiac surgeon operating you said, oh, by the way, just one detail, I never went to med school. You would rip that mask off your face and head for the exits in a heartbeat because you want somebody trained in that craft. You want a professional, and we do not have that in industry, and I don't think we ever will.
Hmm. So, in your view, I guess that begs the question: what makes a professional? Then is it not? Is it like years of experience? Is it like professional certifications such as CAIA, CFA, and so on? Is it a track record? What is it really?
Yeah, so I would like to say, and I'll pick CAIA because that's near and dearest to my heart, that the only true professionals are individuals that carry the CAIA credential. I wish that were true. There are bad actors in every field. There are bad actors in every industry, bad actors in every profession. So if I had to sum it up, credentialing is part of it because it shows a commitment and a demonstrative move to absorb a body of knowledge that has ethics at its base. But if I had to sum it up, what does it mean to be a fiduciary? It means doing right by the client when nobody is looking. The gray area of what defines a fiduciary is very, very wide. And there's a lot of things you can do within that gray area without getting your local regulator really agitated about you. But have you ultimately put the best interest of that client first? Maybe,
Mhm.
maybe not. I'm a capitalist through and through, so this is by no means dismissing the purpose and place in our industry. But as Jack Bogle, the founder of Vanguard, in a paper he wrote circa 2000, uh, every asset manager out there is conflicted. They're serving at least two masters. They've got a client on the one side that they owe a fiduciary duty to, but then they have shareholders if they're a public company. They have partners if they're a partnership, and they have a responsibility to them as well. So I'm not professing that we can will that away or diversify that risk away, but we have to be able to recognize it and disclose it, particularly when it's in a gray area and we just hold our breath that hopefully nobody's going to notice. The regulator's not going to ding me. Maybe the client would be unhappy. Own it.
Mhm.
Own it and go to the client and explain it. And that sounds like maybe an ill-defined definition to do the right thing when nobody's looking. But it's just like this concept of culture. Culture matters a lot. But if it's sloganism in a tagline that sits on your website or in a mission statement, it's nonsense. It is how this organization behaves, not today or tomorrow, but over time. And are they putting the interests of the client first? And if they're not, are they disclosing it when more often than not, those situations present themselves?
So you were talking about shareholders as one of the people that you have a duty to as a money manager. I When we talk about shareholders, obviously we have to think about quarterly results. Public companies live and die by quarterly results that obviously shareholders look at very, very closely. Um, what do you think quarterly reporting does to leadership in decision making? And do you think there's a better way to hold organizations accountable than what we see in quarterly results?
Yeah, so reporting early and often, who could be against that? But again, I think it was Ben Graham, and you might remember this from your CFA studies, the father of value investing, and I've always been a
Mhm.
value investor myself too. And Howard Marks has often quoted this statement by Graham as well, where he talks about public equity markets being voting machines in the short term, weighing machines over time. And you've seen, and right now I don't understand why volatility is so placid in the market, and we can get back to that. But I think investors get overly agitated when there's a bad quarter or bad news, and they usually sell and oversell the stock, and maybe sometimes that could be a very, very good entry point. And as I said earlier, there are no good or bad equity investments. And I think if investors zoom out, they should be thinking about widening the aperture of how they're going to get equity risk exposure, including private equity. Equity risk premia is equity risk premia. It doesn't have a mindset. It doesn't know if it's public or private. But one of the benefits of private markets is it's got a confined shareholder base. They're not releasing results on a quarterly basis. They're transparent, hopefully, with their LPs and the GPs, and there might be board seats involved. But they can make a decision today that might, in a public company, ding the stock price, but it's probably better for the long-term of growth of that underlying business. And I think many public shareholders are not owners of the business. They're just casual traders, and they're buying a share today, hoping that somebody's going to pay them more for it tomorrow. But their ability to influence the outcome, unless you're the Norway Sovereign Wealth Fund with a tremendous holding in a particular company, very, very difficult to do. So back to your original question, I don't know how we solve for it because I think quarterly reporting has its resonance and its importance.
Mhm.
But you could argue that it does potentially more harm than it does good, but suggesting we do away with it is a very difficult statement to make.
Yeah, 100%. There's always like yeah, that tension, but it's hard to think about a world where you don't have those. I guess the perverse part of it is that yeah, a lot of managers take decisions and manage the company in a way that is they're going to show immediate results rather than longer term ones where they might not be around to see the fruits of. But yeah, it's tricky when you know that in 1, 2, 3 months you have like to make that call and people are going to be watching exactly what you've been doing. It adds a lot of pressure and short termism that it's not always healthy probably. Um, Completely different topic now, but you've chaired audit committees, you served on company boards, you advised fund advisors, a lot of roles that demand a lot of independent judgment. And I wanted to ask you, what separates a good board from a mediocre one in your eyes?
So it is a difficult transition to some degree to go from being an operator to an independent director, and then even being a director on a public company versus a mutual fund have very different aspects to it as well, where you're primarily moving toward a role of risk oversight and trying to be the arbiter of conflicts of interest versus
Hmm.
trying to tell management how to better run their business. That might be true in a PE model, certainly not true in a 40 Act fund board. So it's a very different mindset. And if you grew up and had a very successful career in asset management, and you bring that same mindset to the director chair, you might be one of the worst candidates. And then if you make it through the gristmill, one of the worst directors to have sitting on a board. So it is a very different mindset, a very different approach. And you're ultimately there as the watchdog for the shareholder. That's the role you're playing. And risk oversight is, as I said, a primary part of the responsibility. But the interesting aspect, and I think this is true of everybody's career, including the independent director. In the good old days, say if I go from the 1980s up until maybe 2000, 2005, so before the GFC and before the rise of the private markets that we've seen, and before digitization and TradFi to DeFi, if I had a successful career in asset management and then I retired and sat on a board of directors, the risks I'm overseeing are very comparable to the risks I encountered in the course of my career. And I just had to reset my mind around oversight versus solving for those risks. What the challenge we're faced with today as an independent director is that most directors have not seen the invasion of digitized assets. They've not seen the use of blockchain in the back office. They've not seen the invasion of all of these private capital offerings inside of potentially a 40 Act mutual fund wrapper or some other interval fund. They have not seen some of the challenges around price discovery, what this means to side-by-side management. If this holdings in a mutual fund has got to be marked to market every single day, when that same holding might have been in an institutional drawdown fund where maybe it was marked quarterly, but that mark didn't matter until the asset was disposed of after a 7 to 10 year fund life. So I think the challenge for investors that we're representing, and ultimately the challenge for individual independent directors, is the job has gotten a lot more difficult. The risks have gotten a lot more difficult, and the risks are nothing that we've seen in the course of our career. So I very much believe there's a responsibility and a tremendous burden for the independent director, not to be the expert on any of these areas, but staying current is critically
Hmm.
important. And maybe just as a quick aside, and you may have missed this in the lofty intro that you gave to me, one of the most important things I'm doing now at this phase of my career is I sit on the advisory board of CIFD, Certified Investment Fund Director, which is a credential out of the Institute of Banking in Dublin. And I think that this is small and awesome at the same time, and maybe much like what CAIA was 20 years ago, where they're saying exactly what I said a moment ago. They're saying, in this case, the INED, the Independent Non-Executive Director overseeing a UCITS fund in Dublin, you can't just show up and expect that you know what you're doing. You need to go through a program like ours, get this credential, and prove that you not only know what's going on today, but you're making a commitment to stay continually educated as you move forward. And I think that
Mhm.
type of responsibility for an independent director, with or without what CIFD is doing, is very, very important.
Well, I must say that you are part of so many initiatives that it's almost impossible to follow up with everything you're doing. Because something else you've done is that you've helped launch the FDP Institute that bridges the gap between data scientists and investment analysts, two groups that don't necessarily speak the same language. Um, why did you launch that institute, and why did you think it was critical for the future of investing? Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Yeah, so the launch story is short, but maybe self-aggrandizing to some degree, because I was there at the beginning with my very good friend and colleague Hossein Kazemi. But I talked to Hossein circa 2018 and said, "Hey, Hossein, no, I'm out there a lot. He's active in the industry and a great academic. But I said to Hossein, if I look at all the events I've been to this year." Back then, and maybe less true today, ESG in all forms was very, very topical. But
Mhm.
digital disruption, and maybe not the same digital disruption we're talking about today, but the hiring practices we saw some of these big asset management firms, where if you ask them, maybe this conversation minus 1 year, where they hired their talent from, the B schools and the competition. Now is NASA, Google, Microsoft, and they're bringing people in with no financial training at all, but are very well steeped in working with data sets, the STEM-based studies behind it. They know Python and R, and this is before ChatGPT could maybe solve for some of that. So as the story went, Hossein and I talked about the fact that a CAIA or CFA can work the dividend discount model. They know due diligence. They understand how privates can fit into a portfolio from an allocator standpoint. But how do they interface with the data scientist who's working with these zettabytes of vault data, maybe overfitting it, but we have no way of telling because we don't understand Python and R? How do we bridge that gap? So that was the formative principle behind the FTP and FTP Institute, was to bridge that white noise more for the analyst and not turn them into a data scientist, but give them the conviction, the knowledge, the courage to challenge the data scientists so they can all work together in one co-joined investment process. So maybe I'll ask myself the natural follow-up question is, okay, so you started it in 2018, sound like a great idea. How's it going today? Uh,
Mhm.
the COVID bubble hit and hit CAIA, hit CFA, hit CFP. Our numbers drew down a little bit. They're now back above that baseline, which is great news. I don't think every credentialing body can say that, but something had to give. And our ability to make the investment in what FDP really required, where you've got a curriculum is changing in warp speed. Unlike, again, where CAIA, the curriculum changes, but not the underlying is not as dramatic as it is when you get into the field of alternative data and data science. So I did not want FDP to die. We found a great partner in Alpha Development, Paul Monk, who's the CEO. I spoke to him today, and just like I'm speaking to you, Ignacio, I spoke to Paul Monk, and here I am doing a podcast and talking to the CEO of FDP. So it just shows where my priorities are and how important these things are to me, and I know to you as well. And my conversation with Paul was all about this level of disruption, and FDP through Alpha Development is coming out with an AI-based tutor to go with this curriculum. I think this is land-breaking news coming out of FDP. Is it going to rock the world today? No. It's going to be headline news in the FT on Monday? Most likely not. It'd be nice if it was. But you've got individuals who are now partnering with us on FTP, and I'm still on the advisory board there, that are saying uh, every industry is going to be disrupted, including credentialing. And if CAIA, CFA, CFP are sitting on their hands saying, yeah, that's all right, we'll figure this out, good luck with that. The numbers will continue to draw down. Eventually, you can have an unsustainable business model. And we're moving toward a world where the individual, even if it's coming from B to B to C, the individual saying to themselves, I've got this very specific blind spot in my makeup as a professional. I need to solve for that today because that area is moving so very quickly. The likelihood that a CFA could fill that void where it's 900 hours of study time, a lot of stuff that's not related to that specific issue. I'm not saying it doesn't have resonance, but this is also true in higher education. I've got 5 kids. I paid a lot of dollars in tuition. And whenever I go to one of these orientation sessions, I say, I'm a consumer of a very expensive product. I don't give a crap about how nice the pool is in the dorms or the meal plans. I assume you're going to feed my son and daughter and they'll have a nice time on the weekends. But I've got to know, after the amount of money I've invested at the end of the 4 years, you're teaching them something that is worthwhile in the business world today. And it doesn't mean that the arts and English and geography and history are not meaningful majors. Absolutely, the arts make sense. But we've got to have business schools that are teaching what is going on in the business world today. And I think that gap is continuing to get wider and wider. It's true in the credentialing space, true in higher education. And we've got to get that fixed. Otherwise, I think we're going to see a lot of brand names that once had resonance that are not worth nearly what they are into the future.
I can't believe you have 5 kids. You look super fresh. I have 2 and I look more tired than you. So
Well, I've got and now
maybe
2 grandkids just in the last couple of
oh my
months, which is
God. Well,
exciting.
congratulations. Maybe you
Thank
should
you.
share the secrets of the eternal youth. Maybe it's financial markets. Who knows? So you were talking very briefly about AI, and I feel we cannot talk about finance without at least mentioning it a little bit, because it's 2025 now, and Gen AI is the latest shiny object. You cannot dial into a conference call without having it come up at some point. Where do you see the real promise in AI for investing and finance in general?
Well, it's still early days. If I think about maybe the biggest miss that I see, and there's no shortage of investment product and no shortage of assets to go into those products. The big miss is advice. The advice industry
Mhm.
is old, and it's I think to some degree broken, in that the average financial planner here in the U.S. is probably a white male in their 60s. And there's a reason why, when the life expectancy of a couple, if it's a man and a woman, the male dies usually before the woman, just the way the tables have proven out over periods of time. Most cases, the woman fires the advisor because they don't know the advisor. They've never met him. That was the husband's job. So I think that we've got to not only recognize its demographic movement, the kids are going to be inheriting the worth of the baby boomers. And I'm on the trail end of these baby boomers. Cerulli is estimating that that's $100 billion of assets going from the owner of the asset, the baby boomer, downstream to the individual of the next generation. So $100 billion. We've got to figure out what is our responsibility with that investment. Do they know what they're doing? How are they going to be investing it? These are very, very important questions to ask and answer. And we have a period of uncertainty here where AI, I think, can help with some of this, not on its own, but I think there could be a lot of investing tools going to help bring forward this educational prospect to these individuals.
So, what are you going to tell your grandkids? Look at it as an opportunity. Be mindful of its limitations. Don't become too dumb, and try to keep some critical thinking of your own. But familiarize yourself with it. Is it along those lines?
Yeah, so it's a little bit of all of that, and I may have misstated this transfer of wealth. It's in the trillions, not billions of dollars. I think I said 100 billion before, but these kids and grandkids, there's going to be no shortage of people coming to them and saying, "I can help you," including the algorithm. And robo advice is good, but it has its limitations as well. And I think maybe a phrase that has benefited me in the course of my career is reject nothing but question everything. So don't take anything at face value. Do a little bit of homework, do your due diligence. You don't have to be an expert on anything, but be expert enough that you can ask the question, you can hear the answer, and don't be afraid to ask that follow-up question. These are critically
Mhm.
important. And I posted something on LinkedIn. It was a front page story in the Wall Street Journal just last week, and I forget the context of it at the moment, but it was another garden variety fraud where it had to do with either SPACs or IPOs. And this was here in the US. And I think the founders got charged by the SEC, and we'll see where things go. But I would like to think that if I'm an investor and I have this idea presented to me, I fall in love with the idea because it's promising me all the upside and no drawdown risk. And I'm nervous about the future, so I sign on. But if I had an app on my phone where I could just put that name in, and that name would then go into some form of generative AI and pull every news story, every public statement, every view, and search Yelp and whatever else is out there, Reddit, and it would give me a consensus, thumbs up or thumbs down, that this smells like a fraud. And I think that tomorrow's headline in the Wall Street Journal, put through that simulator today, would give the thumbs up on a fraud. So I think there might be some simple wins where at least we have a clearinghouse of posers and fakers out there to
Mhm.
prevent some of this damage before it hits in the first place. But I think it's back to something we talked about at the very beginning of this conversation. Who's against preventing fraud? Who's against financial literacy? Who's against financial education? Nobody is. But who is stepping up to say, this matters? It doesn't matter what my ROI is. And again, maybe tying the last point into this news story, when we have articles like that, I always sit there and wait for the industry outrage. We're the big guns to say, this is absolutely unacceptable. Because the reality is, even if it's 5% of the cases pollute the water, it doesn't take much to drink before you're going to get poisoned too. So this is counterproductive to the business model of the very best actors out there. And they should be taking a stand. And I don't nearly see enough of that. And maybe I don't see any of it. Maybe I'm looking in the wrong publications, but we've got to take a stand against actions like this one I alluded to last week, and then demonstrably step up to say, education, financial literacy matters, and we're going to make an industry investment in this that's going to be sustainable.
We're running out of time, getting close to the end of the conversation, so I need to be very intentional with my last couple of questions. One I wanted to ask you about, related to financial education for finance professionals, is storytelling. How do you think about storytelling when it comes to finance? Because I have the feeling that it's back in fashion. Like, everyone is talking about it as one of the most important skills to pick up in today's environment. So going beyond just the numbers and the technical part, but really learning how to tell a story that connects with an audience. What's your take on that?
So maybe I'm biased because this is my resting pulse. I think it matters a lot. And if you look, and you very kindly gave a shout out, but if you look at my newsletter or look at my podcast recordings, or if you hear me speak on a podcast like this or anywhere publicly, you'd be hard pressed to find a lot of industry jargon. Hard pressed to find a lot of reference to Greek letters. And I think we could talk about concepts like risk in very plain language. Talk about why the liability side of the balance sheet matters more than the assets in very plain language. And I think this has a benefit to helping the end investor understand some of the risks and opportunities. So storytelling, as long as it's not an outright fable, I think is a very, very important part of the narrative, because it pulls the investor into an industry that is so very opaque. If you and I need to have a repair to our car, or the dentist tells us we have a filling that's broken, we trust them. And hopefully we've done our work, but I guess we can go get a second opinion, but we're not going to go back home and get under the car ourselves, or try to get that tooth into the camera to see if the filling really is broken. But the downside risk of something like that is relatively small versus leaving it to trust and fate. If you're turning your assets over to an individual, the damage that they could do in 5 months or 5 years might be irreparable over the course of the rest of your investing lifetime. So these are not small issues. They're not uncomplicated issues. And the more we can distill this narrative down to words the investor can use and understand, we've done something right by them.
Music to my ears, Bill. That's music to my ears. One last question. I like to wrap up my show with a piece of advice, maybe for our listeners in their, let's say, 20s, maybe early 30s, in order to have a successful career, maybe make it 4 decades as you did. What would you tell them?
Well, I think that maybe it has a lot of underlying narratives, but stay curious. And stay curious means stay informed. It means ask questions. It means being a good listener, taking that information in and asking the right follow up question. But being a student of the markets, a student of what you do is so, so very important. And I love this industry. I said I've been in it for many, many decades. And one of the reasons why I love it so much is every single day I learn something new. And I can learn it from a discussion with somebody like you. I can learn it by reading the FT. I can learn it by reading The Economist. And a lot of publications have their own political bent, sadly, in reality today. So you should take in and consume as much information so you can form your own opinions, form your own biases, and hopefully those biases are based in fact. But maybe just one other thing I'll add to this, and you alluded to it before, and it's a very, very important point. Long-termism matters. We have elected officials that might be there for 2, 4, 6 years. So they're trying to maximize that role for what fits their best interest. They're trying to get reelected, so they're going to promise things, and it might be crazy in the long term, but it gets them elected in the shorter term. Same thing with CEOs. Their tenure on an average basis is relatively short. They want to monetize what that means for a W-2, their take-home pay in the U.S. And I'm not saying they're all wired that way, but we have an industry that's focused on short-term reward when building a portfolio. Building wealth is a long-term pursuit. If we could teach nothing to the end investor or to the individual starting out in this industry, long-termism matters. If you're trying to get that ideal job at Goldman Sachs or KKR or Carlyle coming out of school, if it's there for the taking and it's very competitive, go and get it. But don't kill yourself if you can't. Get yourself involved in the very best career start that you can, hopefully a global organization with good training, build your network, believe in yourself, and be the CMO of you, because you're the only one that's going to care enough about it. You can't fire yourself as CMO. You should maximize the potential and recognize life and career have setbacks. In the long term, if you're focused on it, you're going to do just fine.
Be the CMO of yourself. That's probably the quote of the day. Bill, it's been absolutely a pleasure to have you on the show. Thank you for sharing all that knowledge, all those tips, those stories. It's been, fantastic to hear all of these. And I wish you all the best for the upcoming years, maybe for the upcoming 40 years of your career in the finance industry, who knows? But yeah, I will keep a very close eye on all the initiatives you're currently working on in this new stage of your professional career. And once again, for those of you that are not following him already, please go to LinkedIn, check out Bill on socials, but mostly on LinkedIn where he's active, and you'll find all the information regarding his podcast, regarding all the projects he's working on, and I strongly encourage you to do so. Bill, thank you so much for coming to the show, and I wish you a wonderful rest of the year.
I do as well. And just a quick shout out to Melix, who got us together on this. An awesome member, awesome friend, and I thank her profusely for putting this together. So all the best, Ignacio. I enjoyed it.
Thanks for Melix. And maybe one last thing, actually, talking about Melix, because you both are in this quantum computing group applied to finance. Can you tell us in a couple of words what is it exactly that you guys are working on? Because it sounds insane.
Yeah, so I wish I knew more to tell you, and this gets back to what excites me every single day. You could fit my knowledge of quantum computing in a thimble, but I was asked both to join this network, which has been terrific. I was asked to moderate a panel of MIT alums, so smartest scientists in the room. And even with this MIT group, when you talk about quantum computing, you can get over people's skis very, very quickly. And I was getting a message of there was over 200 people in this webinar. You got to dumb this down. So I think it's back to the last point we made, that you got to put complex subjects into a story I can understand. And if you can draw me in, I can build on that. And everybody's going to learn at their own pace. So this quantum boardroom, it's early days, but the future is going to be quantum computing. When it happens, we could debate that. It could be years or decades away. I think it's more years than decades, but it's going to be a game changer to classical computing and what it means around things like cybersecurity. So we don't have enough time to get into it deeply, but if you're a listener and you're hearing about quantum computing for the same time, you should learn more about this. And this Q day, if it comes about, Google it. And that will give you enough fear to say, I've got to get up the learning curve yesterday on quantum computing.
I definitely need to learn about it, and I am already planning to do something about it. I invited Osvaldo, who's also in this quantum computing group with you.
Outstanding individual, and he'll be a great guest.
Yeah, he accepted to come to the show, so he'll be coming in a few weeks. So stay tuned if you're interested in how to apply quantum computing to finance. Bill, thank you so much, and have a wonderful day.
Thanks, Ignacio. All the best.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.